Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, interest rates on bank FDs have been at multi-year lows, but thankfully now some banks have started increasing them. So if you're wondering if the rate hike is sufficient enough for you to use bank FDs as an investment avenue for your long-term money, stay tuned, watch today's episode carefully, you will get all your answers.
Interest rates are going up because the central bank, the Reserve Bank of India, is increasing the rates. The way they increase the rates, which every bank has to follow, is they increase the rate at which any bank can borrow money from Reserve Bank, or if a bank has a surplus money, they can give that money to Reserve Bank to earn that rate of return. So the rate at which the bank can borrow from Reserve Bank is called repo rate, and the Reserve Bank determines that. And the opposite of that, when a bank has a surplus money, that is called reverse repo. And these two things are announced and controlled by Reserve Bank. So Reserve Bank can very well increase the rates or decrease the rates depending on the context, depending on the situation. Why Reserve Bank increases rates or decreases rates? The theory is that money supply adds to the inflation, and governments don't like unhindered price rises. It affects every citizen. Rising inflation is being referred as a tax on the poor people because the price is going up for everyone, and affluent rich people can afford it, but the poor people will actually suffer more because they can't really, their income don't go up in line with the rising prices. So it is being referred as a tax on the poor people. So that is why it's the public policy, it's the goal of the public policy, the central bankers, to coordinate or control their interest rates in a manner that can influence inflation, and it is primarily to control inflation. The hike is quite significant, or I would say quite sizable, but how meaningful it depends on the saver. Let me just explain you what I mean by that. It is significant in the sense that the rates have gone up quite sharply in recent past. But how meaningful they are? Not very meaningful, because the rates have gone down to such lows that even if they have gone up quite substantially, it does not make a meaningful difference. Let me just explain you with an example. If you have a crore of rupees of deposit, 5% interest on that deposit would have been 5 lakh rupees, and reduce it by 30% and it becomes 3,20,000 rupees. Compare that with 6% and reduce it by 30%. 30% tax paid out of that, so your income has gone up from 3,50,000 to 4,20,000 rupees. So it has gone up, but I would rather say that it is not meaningful enough. It will not make a substantial difference to your life because the rates have gone down so low that even if the kind of hike that or the rise which we are seeing is not making a hell of a difference to your income as such. Based on RBI's commentary in the monetary policy review updates which happens every quarter, looks like interest rate hike cannot be ruled out, or there's a great likelihood that based on the situation and its own narration, it is a possibility which can't be ruled out, very likely, but nothing is guaranteed. So my suggestion to investors will be, long-term depositors will be, that don't lock your money for long term, because if you make a deposit for the long term, if you do a 5-year deposit and tomorrow the rates go up, then your money is locked, and so you will have to get a premature encashment and reinvest it again, and that will have its cost. So consider short-term options. There are small banks which have been licensed in recent past to start, and they started their operations to attract new customers, to attract new depositors, and more so in the smaller towns or bigger cities, to gain attention. They are sweetening the deal by offering a higher deposit rates. and that doesn't mean that they're unsafe. It's just that they, because of the competitive landscape of the banks in the country, some of these new entrants, they are actually trying to attract new customers, and that is what is making these deposits yield higher return for you. Are they unsafe? No, not really, because RBI governs all these banks. They are well regulated. There is a capital adequacy mandated for them, and but to keep in mind that only up to 5 lakh rupee deposit is insured. So if at all you have say 25-30 lakh rupees, and the most important money, if you completely depend on this, I think there should be a hierarchy of your fixed income investments, and that should start with something like, at least for the retirees, it should start with senior citizen savings scheme, then followed by the Pradhan Mantri Vay Vandana Yojana, then followed by post office MIP, and then comes the deposit. And if you have the choice, maybe spread your deposit in 2-3 banks, 2-3 of these smaller banks, and with keeping in mind that it is not crossing 5 lakh rupees. Indian depositors love fixed deposits for a variety of reasons. First and foremost, the history. In India, historically, the interest rates have been high, and our bank was nationalized. So it was high return, high absolute return. I would not say high return, because if we look at inflation in the past, in the last 30-40 years, and when we compare that with the interest rates, it was not that large. But the absolute return, investors were quite used to 10, 12, 13% return. And because the Indian banking industry, a substantial part of it got nationalized, so it was also perceived as safe, and none of the government banks ever failed. So safety coupled with perceived absolute decent return from the deposit, and then followed by the post office savings schemes, which also yielded high return in those times. In the regulated economy, Indian investors had every reason. Whenever investors ventured for something which was not a deposit, they often, you had a sorry story. So investors, that also contributed to the preference for something which is absolute safe or safer options. And this is where the deposits actually serve the need. But continuing with the old ways that go with the safety, go with the modest return, the high rate of return historically which was available to Indian depositors is no longer available. So that is one reason why you should reconsider this. The other is that the absolute return on your deposits might be positive, because inflation rates, if they go down, you might be earning 5% or 6%, and if inflation is 4%, then you are okay. But for many investors, 4% or earning 6% may not just be may not be okay, may not be enough. As I was saying in the example earlier, that if you have 1 crore of rupees, and assuming you are not a taxpayer, and you are earning 5 lakh rupees, and now if you earn 6 lakh rupees, I would say that for any investor or any saver who has accumulated 1 crore of rupees, will not be very pleased with this kind of return, this kind of guaranteed return on their lifetime accumulation, and that too at a stage where they may not be prepared to take risk with their investment. So it may not be a wise thing to be a complete believer and have let fixed deposits dominate your investments. You have to take risk in a measured way, in a manner that you learn how to take risk. You learn how to take risk so that it does not hurt you, and that I think is critical, and which means embracing equity, understanding where the risk comes from, and if you don't do it, I don't think the fixed deposits are going to be a solution for most depositors or savers in the coming times. Deposit rates are going up, and many investors might be tempted to make more deposits. But I don't think investors should be governed by the rate of interest rates or the state of the market to make investments or to do their deposits, simply because You should be guided by your goals. You should be guided by the time frame that you have. You should be guided by the risk tolerance that you have. For somebody who is 25-year-old earning and is able to save, and the savings that is, the amount that you are saving, you are unlikely to need for next 20-25 years, by all means put all that money into equity. Don't even bother about asset allocation, simply because you have no accumulation for it to actually suffer from a decline in the market. Likewise, if you are approaching retirement, you need to have meaningful allocation to fixed income so that all your money cannot be in equity. Likewise, you should have an asset allocation. You should have an asset allocation depending on how much decline can you withstand, what is the scale of investment. Because, but interest rates going up, and should you make deposit? No. It will be worthwhile to take a stock, because the way interest rates have collapsed in India, even if they go up, they are unlikely to make a meaningful contribution to you. I think investors need to look at things very objectively. You should make some deposit. If you are young and if you are able to save some money, then have your deposit. Let some money lie in your bank account. Let's make some small deposit, and that should be your emergency fund. That is the money which you can lay your hands on anytime you need it. And beyond that, if you are a long-term investor, investors should not invest their long-term money. Long-term money meaning 5-7 years and more, the money which you are unlikely to need for that period. That money should not be into fixed income. And the money which you need, the emergency money, should be in fixed income. There should be a small part of your allocation. At a young age, that should be a small part, maybe 10, 20, 30% of your money should be in fixed income. That is not to really earn fixed income. That is primarily to provide stability to your overall equity portfolio. If 70% of your money is in equity, 30% is in fixed income, if market collapses, you will not see the big collapse, and you will also have some money in fixed income to benefit from such a collapse. And as you get older, then you need to become a little more conservative. Then, depending on your scale, your money should be substantially into fixed income or dominantly into fixed income, depending on how critical you depend on your income from investments. If you have, say, 50 lakh rupees and the return that will be generated, it is critical for your day-to-day or month-on-month, your living expenses, then ideally it should be substantially into fixed income. But still 5 to 10% of your money should be in equity, because there is no other way you can prepare your investments to beat inflation over time. Because if you have 50 lakh rupees, if it is fully invested in fixed income, the return it generates you consume, then 50 lakh rupees today will remain 50 lakh rupees 5 years from now. And when it will generate any return, that will not be enough, because your capital has remained constant. So it is important to invest a small part of your money, whatsoever it be, in equity to ensure that your capital's worth is protected. This should be your long-term strategy to protect your capital from getting beaten by inflation, because you might think that your money is growing, but it is going down in value despite, you will think that you have 5 lakh rupees and it has become 6 lakh rupees. But by the time it has become 6 lakh rupees, the worth of that 6 lakh rupee, its ability to buy things, will be for much lower. So this is one thing. For extremely conservative investors who believe in fixed income, who have been fixed income investors, their approach should be that they should list a hierarchy of their investment. The first one should be all your accumulation in public provident fund. You should retain that, because it gets you a high return, as well as all the interest income earned from PPF is tax free. That should be followed by high quality debt funds, and then it should be followed by your matching requirement, the term for which you want to invest. You can well consider target maturity fund. So these are your options. These are the options for the fixed income for the conservative investors.
Well, with that, it's a wrap. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Thanks for watching. Bye for now.